In an unexpected turn, the global tech market faced a significant downturn on January 27, 2025, as fears over competitive advancements in artificial intelligence (AI) from China sent investors scrambling. The emergence of DeepSeek, a Chinese AI startup, has raised alarms among industry giants like Meta and Microsoft, leading to a reevaluation of projected profits and valuations across the tech sector. DeepSeek, founded just over a year ago by Liang Wenfeng, has gained traction for its ability to match or even exceed the performance of leading AI systems such as OpenAI's ChatGPT while utilizing a fraction of the computational power and associated costs. This efficiency challenges the conventional wisdom that developing sophisticated AI requires increasingly powerful and expensive hardware. The company's open-source approach has encouraged further innovation and contributed to its rapid rise, exemplified by its mobile app's swift ascent to the top of the iPhone download charts in the U.S. soon after its launch in January. The impact of DeepSeek's advancements on the stock market was immediate and profound. At the market open, the S&P 500 fell over 2% and the tech-heavy Nasdaq dropped by 3.5%. Nvidia, a key supplier of AI hardware, saw its shares plummet by approximately 13%, erasing hundreds of billions in market value. Other semiconductor companies, including AMD and ARM, also experienced significant declines as investors began to question the sustainability of the tech rally that had previously driven substantial profits. "This is a big slap in the face for investors," noted Steve Sosnick, chief strategist at Interactive Brokers. He emphasized that the influx of competition represented by DeepSeek could fundamentally alter risk assessments in the AI sector. Analysts at Saxo Bank echoed this sentiment, suggesting that Nvidia's dominance in the AI hardware market might not be guaranteed indefinitely. Charu Chanana, the bank's chief investment strategist, remarked, "The emergence of DeepSeek serves as a reminder that competition in the global AI arena is intensifying." As the turbulence affected major players, Meta's stock fell by about 3% following its announcement of increased spending on data centers, while Microsoft's shares dropped by 4%. Oracle, heavily invested in AI through its partnership with OpenAI, saw a nearly 7% decline. The repercussions extended beyond tech stocks, with utility companies that cater to the energy demands of data centers such as Constellation Energy facing a more than 13% drop in their share prices. This downturn comes at a crucial moment as major tech firms prepare to report their quarterly earnings. Analysts are likely to scrutinize the financial outlook of these companies more rigorously, particularly in light of growing competition from Chinese firms. DeepSeek's entry into the market has not only threatened the established players but also raised significant questions regarding the future of AI investment strategies. In response to these developments, U.S. President Donald Trump has pledged to boost American AI production to contend with China's advancements. He recently signed an executive order aimed at streamlining the development of AI technologies while imposing restrictions on the export of advanced semiconductors to China, a move intended to curb potential rival advancements. Despite the alarm bells being rung by many in the industry, some analysts remain cautious about concluding that DeepSeek's emergence spells disaster for US-based AI developers. Bernstein analysts pointed out that the computing capacity freed by such efficient AI systems would likely be absorbed by the growing demand for AI applications. They stated, "We are still going to need and get a lot of chips," suggesting that the market's fundamental drivers remain intact. As investors in tech companies brace for the implications of this new competition, the future of AI development and investment is poised for a potential reconfiguration. With DeepSeek challenging established norms and expectations, the landscape of artificial intelligence is set to evolve, possibly ushering in a new era of innovation and rivalry on a global scale. In a striking turn of events, the Chinese government's response to growing criticism regarding its drug procurement practices has led to the sudden removal of public data on domestic pharmaceuticals. This development comes on the heels of an increasing outcry from medical professionals about the quality and efficacy of drugs supplied to the nation's public healthcare system. The controversy underscores a significant tension between economic measures aimed at cost reduction and the fundamental need for effective healthcare. The spotlight on this issue intensified when a group of prominent doctors voiced concerns over the quality of domestically produced generic drugs, which have largely replaced imported medications in the national healthcare system. According to medical experts in both Shanghai and Beijing, the centralized procurement system known as volume-based procurement is failing to deliver the expected outcomes. Notable among the products under scrutiny are anesthetics that reportedly do not adequately sedate patients and stroke medications that have not effectively prevented strokes. Even common medications such as laxatives have come under fire for their ineffectiveness. Zhang Minhua, director of surgery at Ruijin Hospital, articulated the dilemma succinctly, stating, "While the centralized drug system has saved the government tens of billions of dollars, these cost-cutting measures may come at the expense of drug effectiveness." In response to these alarming findings, Zhang, along with over 20 fellow doctors, has called for policy changes to allow patients access to brand-name drugs that are not included on the government's list. As the criticism gained momentum, the National Medical Products Administration (NMPA) found itself at the center of the storm. A doctor and former editor of a health platform, Xia Jiman, highlighted discrepancies in data provided by different drug manufacturers, suggesting potential fraud. The NMPA acknowledged the similarities in reported data were due to editing errors, a justification that failed to satisfy the public's growing concerns. The agency's decision to remove the data from its platform, coupled with the deletion of Xia's critical analysis from social media, sparked further outrage. In a bid to quell the backlash, a state-run publication, China News Weekly, echoed the sentiments of experts advocating for increased transparency in drug information. A good pharmaceutical quality control system requires adequate information disclosure and transparency, the article stated, reinforcing calls for accountability within the NMPA. This unfolding saga reflects broader implications for China's public health strategy, which is increasingly strained under the pressures of an aging population and rising healthcare costs. As the government grapples with the need to balance budgetary constraints with the imperative of providing effective healthcare, the path forward remains fraught with challenges. Looking ahead, the Chinese government faces mounting pressure to restore public confidence in its healthcare system. The current situation may prompt a re-evaluation of policies governing drug procurement and quality control, as well as a reconsideration of the role of transparency in public health administration. As the voices advocating for reform continue to grow louder, the future of China's healthcare landscape hangs in the balance, with potential ramifications for the well-being of millions of citizens. As the Lunar New Year approaches, China's economy is displaying worrying signs of stagnation, prompting analysts to call for increased fiscal support to stabilize the situation. Recent data reveals a significant drop in manufacturing activity, with the official Purchasing Managers Index (PMI) falling to 49.1, the lowest level since August. This figure starkly contrasts with economists' expectations of a modest recovery, highlighting a deeper malaise in the industrial sector. The non-manufacturing PMI, which reflects the performance of the services and construction sectors, also declined to 50.2, barely above the threshold that indicates growth. The unexpected slowdown has raised alarms among economists, who note that while factory activity often decelerates before the new year due to seasonal production adjustments, this year's decline is notably severe. Raymond Young, chief economist for Greater China at the Australia and New Zealand Banking Group, remarked, "The extent of decline is beyond our expectation," emphasizing the need for a more robust fiscal policy response, including potential cuts to the reserve requirement ratio for banks. The impact of this economic downturn is reflected in the financial markets, where the CSI 300 index of onshore Chinese stocks fluctuated, ultimately closing down 0.4%. Meanwhile, the yuan depreciated by approximately 0.3% in both domestic and international trading. These movements indicate growing investor concerns about the sustainability of China's recovery trajectory, which had previously been buoyed by a late-year export boom and government stimulus measures. Despite meeting its official growth target of 5% last year, the recovery has been uneven, characterized by persistent challenges in domestic consumption and a fragile jobs market exacerbated by a prolonged real estate crisis. In 2024, industrial profits at large Chinese companies fell by 3.3%, marking the third consecutive year of profit declines. Although December showed an 11% increase in profits, the overall trend remains concerning. Compounding these challenges is China's ongoing struggle with deflation, which has persisted for 6 consecutive quarters. As prices decline, consumer demand weakens, creating a vicious cycle that discourages spending and investment. Notably, a recent report revealed that approximately 65% of the population lives below the middle income threshold, with many individuals earning less than 3,000 yuan, approximately $412 per month. This economic disparity highlights the challenges facing President Xi Jinping's administration as it attempts to stimulate growth while managing public discontent over rising inequality. Economists are increasingly doubtful about the effectiveness of the government's efforts to rejuvenate the economy without more substantial fiscal measures. Carlos Casanova, a senior Asia economist, cautioned that, without a more pro-growth stance on the monetary and fiscal policy fronts, it will be hard for China to prevent a sharper economic deceleration in 2025. The urgency for action is amplified by potential external pressures, including threats of new tariffs on Chinese exports from the incoming Biden administration, which could further dampen overseas demand. Despite the grim outlook, the central government has signaled intentions to adopt more supportive fiscal and monetary policies, possibly allowing for a wider budget deficit and interest rate cuts. However, doubts persist regarding the boldness of these measures, especially given the current focus on stabilizing the yuan over aggressive monetary easing. Looking ahead, the trajectory of China's economy will hinge on how effectively it can navigate these challenges. Analysts remain cautious about the near-term future, with many predicting that the country could remain trapped in a deflationary cycle for at least another 2 years. The key question remains whether the government can implement sufficient stimulus to reinvigorate consumer confidence and spending, thereby laying the groundwork for a more sustainable recovery. As the world watches closely, the upcoming months will be critical in shaping the direction of China's economic policies and their effectiveness in addressing the multifaceted challenges at hand. In a climate of escalating geopolitical tensions, U.S. lawmakers have raised significant concerns regarding the national security implications of COSCO Shipping, a state-owned enterprise from China, and its operations within the U.S. maritime transportation system. On January 27, 2025, members of the House Committee on Homeland Security formally requested a briefing from the U.S. Coast Guard (USCG) to discuss measures aimed at mitigating risks associated with COSCO Shipping's extensive presence at major U.S. ports. The letter, spearheaded by Mark Green, the committee's Republican chairman from Tennessee, alongside Carlos Jimenez and John Molinar, underscores the troubling history of the People's Republic of China (PRC) in leveraging commercial entities for intelligence and military purposes. The lawmakers highlighted that COSCO Shipping's control over global container traffic, coupled with its operations near critical infrastructure, poses risks ranging from espionage to potential cyber intrusions. These concerns are amplified by COSCO Shipping's substantial control over global container traffic and its proximity to U.S. critical infrastructure, they wrote. This heightened scrutiny follows COSCO Shipping's designation by the Department of Defense as a Chinese military company, a classification that underscores its role within China's defense industrial base and military civil fusion strategy. The lawmakers are particularly focused on understanding the protocols the USCG has implemented to vet foreign mariners and vessels, especially those linked to adversarial nations like China. They emphasized the importance of ensuring that biographical information from foreign mariners is thoroughly scrutinized using both classified and unclassified intelligence resources. In their correspondence, the lawmakers called for a detailed account of the USCG's vetting process, including its reliance on various data sets for screening operations. They expressed concerns over the potential vulnerabilities that could arise from using foreign-owned data systems for these critical national security functions. Furthermore, the letter inquired about the extent of automation in the USCG's vetting processes and whether safeguards are in place to protect sensitive U.S. data from espionage or cyber attacks. The urgency of these inquiries reflects a broader trend of increasing vigilance among U.S. government officials regarding foreign influence at critical ports, an issue that has gained prominence in light of recent investigations into China's growing maritime capabilities. In a joint report released last September, the House Committee on Homeland Security highlighted the rising threats posed by China-made port cranes to U.S. economic and homeland security. As the U.S. grapples with these national security challenges, the implications of the lawmakers' demands extend beyond the immediate context of maritime operations. They underscore a growing recognition of the need for enhanced interagency coordination and the integration of advanced technological solutions to detect and deter emerging threats. The committee's call for a briefing by February 12, 2025 signals an urgent push for transparency and accountability in addressing the potential risks posed by cargo shipping. Looking ahead, the outcomes of these inquiries could have far-reaching consequences for U.S.-China relations, particularly as tensions continue to simmer over economic competition and military posturing. Should the USCG's processes be found lacking, it could lead to significant policy shifts regarding foreign maritime operations in U.S. waters. As the geopolitical landscape evolves, the scrutiny surrounding cargo shipping serves as a critical reminder of the intricate balance between global commerce and national security. Tensions between the United States and China have escalated as Beijing's top envoy delivered a stark warning regarding the Taiwan issue, which he identified as the primary risk to the stability of bilateral relations. During a Lunar New Year reception held at the Chinese Embassy in Washington, Ambassador Xie Feng emphasized the importance of adhering to China's red lines to foster a stable, healthy, and sustainable relationship between the two nations. His remarks underscore the gravity with which Beijing views the Taiwan situation, reflecting its broader concerns about U.S. policy in the region. The Taiwan question is the question most likely to have a disruptive impact on China-U.S. relations, Xie stated, urging the U.S. to respect the One China principle and the three joint communiques that outline the framework of U.S.-China relations. This includes a clear opposition to any movements toward Taiwanese independence. His comments were a reminder that despite diplomatic interactions, fundamental disagreements over Taiwan remain a significant barrier to improved ties. The ambassador's address comes against a backdrop of heightened U.S.-China tensions marked by military maneuvers and political rhetoric from both sides. In recent years, Beijing has perceived U.S. actions such as arms sales to Taiwan and increased military presence in the Asia-Pacific as provocations that threaten its sovereignty. Analysts have noted that the ongoing conflict in Ukraine and China's support for Moscow have further complicated this relationship, placing it under unprecedented strain. In a related context, former U.S. Ambassador to China R. Nicholas Burns will return to the Harvard Kennedy School as a professor this April, a move that coincides with the growing urgency for nuanced dialogue in U.S.-China relations. During his tenure as ambassador, which began in 2021, Burns navigated one of the most challenging periods in Sino-American relations, focusing on stabilizing ties while addressing issues such as economic competition and military confrontations. His experience is expected to offer invaluable insights to students and colleagues at Harvard, particularly regarding the complexities of diplomacy in a rapidly changing geopolitical landscape. Moreover, as tensions in the Asia-Pacific continue to evolve, recent developments have also emerged in China-India relations. Chinese Foreign Minister Wang Yi has called for increased cooperation with India, emphasizing the need to foster understanding and support between the two nations. This appeal comes on the heels of a meeting with Indian Foreign Secretary Vikram Misri, where both parties acknowledged the necessity of advancing bilateral ties, particularly after a period of conflict along their disputed Himalayan border. The backdrop of these discussions highlights a broader trend in which regional powers are seeking to recalibrate their relationships amidst a backdrop of global uncertainty. As the geopolitical landscape shifts, the interplay between U.S.-China and China-India relations will be critical in shaping future dynamics in Asia and beyond. The emphasis on dialogue and understanding is highlighted by both Xie and Wang, suggests a recognition of the need for diplomacy in resolving underlying tensions. However, the path forward remains fraught with challenges, particularly concerning Taiwan, which continues to serve as the most potent flashpoint in U.S. China relations. How these nations navigate their complex web of interests will be pivotal in determining the future of regional stability and global order.